The risk comes from not knowing what you're doing. WTF? Are you investing, or are you just spending on delusions wrapped in financial jargon? We live in an era where everyone talks about money, but very few understand risk. The market is revered like a god, yet most of its followers are blind to the language of that mythology. You put your money somewhere, a fund, a stock, a piece of advice, and you hope. But what are you hoping for? Something you don't understand, or something that the crowd is also confused about but acts as if they're certain? And if your answer is, I don't really know, then the next question is, have you ever learned to look at a business as a machine that creates real value, not just a fluctuating green and red ticker on a screen? This book doesn't offer a magic formula for getting rich. It reestablishes the foundation for you to understand what ownership is, what valuation is, and what it truly means to invest without the market turning you into a puppet in your own game. Be prepared to go against the grain. Because in this world, the correct ones are often lonely, and the wealthy usually look incredibly patient before they appear successful. One of the strangest paradoxes of the financial world is this: the more fear there is, the easier it becomes to get rich provided you know how to view that fear in a contrarian way. Have you ever heard that? When the market is bleeding, the wise go collecting. But what exactly do they collect, and why do they do it precisely when everyone else is panicking and fleeing? I recall 1987, when the market crashed on a Black Monday, plummeting over 20%. People panicked, frantically selling off, newspapers screamed, and financial news outlets went berserk. Meanwhile, people like Warren Buffett remained calm, even smiling. They knew a secret the crowd didn't. This wasn't the end, it was the beginning. They called it a mispriced opportunity. Think of the market like a supermarket. One beautiful day, you see a sign outside, 50% off all items. What's the first thing you do? You grab a cart and load it up with all your favorite things, right? But when a stock drops 50%, you do the exact opposite. You get scared, you panic, and you run away. Why? Because you don't know the true value of that item in the market. You don't know if it will drop further. You have no basis for making a decision. The wealthy are different. They don't make judgments based on emotion. They don't invest based on money flowing into a stock ticker. They do the opposite. They patiently, quietly wait for opportunities. On those rare occasions when the market offers a price far below true value, they have cash ready. They've done their homework. They know what they're buying, and when the moment arrives, they act without hesitation. The wealthy understand that the market constantly swings like a pendulum, from extreme greed to extreme fear and back again. But the true value of a business doesn't move nearly as much. It's far more stable. The question is, do you have the courage to act when everyone else is trembling? Let me tell you about my friend Mike, who started investing in 2001, just as the dot-com bubble burst. At the time, everyone thought the market was dead, but Mike saw the opposite. He didn't rush to buy tech companies that were burning cash like wildfire. Instead, he chose companies with real cash flow, real assets, companies the market had forgotten. In 3 years, Mike multiplied his wealth fivefold, not through luck, but by understanding the laws of emotional cycles. The absurdity is that people invest with the desire to avoid risk, yet they behave entirely emotionally, and it's precisely these emotions that create true risk. I once sat for hours in the office of a major fund manager where people relied solely on algorithms, beta, alpha, and market capitalization ratios, forgetting the most crucial elements: true value and margin of safety. The wealthy don't play guessing games. They don't hope the market will rise. They only buy when they are certain they are buying below intrinsic value. And if the price continues to drop, they buy more. They don't worry because they're not speculating. They're investing with clear goals, and they use time as an ally, not an enemy. Remember, the market doesn't create money. Smart investors make money by how they utilize the market. The market is merely a collective emotional meter. When people are greedy, it's overheated. When they're afraid, it cools down, and that's when it's time to light a fire. You don't need to be a financial genius to do this. You just need to learn to see the world through the eyes of patience and reason. You need to know the true value of a business, not its listed price, but the actual value it creates. You need to learn to wait, and when the time comes, act like a whirlwind. And most importantly, you must learn to be silent when the crowd is screaming. In moments of market panic, when the media is broadcasting news of collapse everywhere, that's when you should pick up your phone and place a buy order. Not because you're crazy, but because you are prepared. I was once invited to speak at a large investment conference. The room was packed, mostly with middle-aged people with families trying to find smarter ways to invest for their retirement. I asked them, "How many of you feel you don't have control over your financial future?" More than half the hands went up, which was no surprise. We've been taught that investing is something only for experts, a complex maze of charts, algorithms, and vague economic forecasts. But what we haven't been taught is that investing is actually very simple. If you know how to value a business just like you'd value a house, you can invest. If you clearly understand what you're buying and know the reasonable price to pay, you'll always have an advantage. The problem is, no one teaches us that. And so, we entrust our money to others, to mutual funds, financial advisors, packaged products with fancy names. But none of them are truly accountable if your money vanishes. Take the story of a couple in Florida I call Jay and Sarah. They worked hard for 30 years, saving every penny and investing it all in a mutual fund recommended by their local bank. After the market plummeted in 2008, they lost 40% of their life savings. And the fund manager? He still had his big house, his nice car, and a cold apology. Jay looked at me and asked, "What did we do wrong?" And I had to reply, "Your only mistake was trusting a system that didn't care about you." So what do the wealthy do differently? They never let others control their money. They learn, they read financial reports, they ask questions, they understand how a business operates, they know who's running it. They know if that business is sustainable. And when they buy shares, they consider it buying a real piece of a business, not just a stock ticker for speculation. I once spoke with a retired veteran who wanted to invest his retirement money. He said, "I don't know anything about business." I asked, "Have you ever bought a house?" He nodded. I continued, "So, when you bought your house, did you check its condition? Did you compare prices in the surrounding area? Did you make sure the neighborhood was safe?" He replied, "Of course." I smiled. "Then you know how to value something," I said. Investing is like that. It's not a game of chance, not gambling, but careful, strategic evaluation. And once you understand that, you won't fear the market anymore. On the contrary, you'll wait for it to drop so you can buy in. Because when the market falls, it's not a disaster, it's a shopping spree. I'm not saying you'll never make mistakes. Everyone makes mistakes, even someone like Warren Buffett. But if you stick to the principle of only buying when the price is below its true value, you'll always have a margin of safety. You don't need to be right 100% of the time, just right at the crucial moments. Most people's biggest fear when investing is losing money. But that's because they don't control what they're doing. They buy based on advice, on emotion, on trends. They have no strategy, no principles. And so, they easily panic when the market reverses. Getting rich isn't accidental. It's the result of understanding, discipline, and the courage to go against the crowd. The wealthy aren't rich because they're smarter, but because they dare to look at the market through a different lens. And you can do that too. You don't need to be an expert. You just need to be willing to learn, willing to ask questions, and most importantly, willing to act when opportunity arises. If there's one thing Wall Street has sold us better than any product, it's mutual funds. They say it's the easiest, safest, smartest way to invest for the future. They tell you to just work hard, contribute money regularly each month for them to manage, and you'll have a comfortable retirement in your old age. Sounds logical, right? But what's the truth? Most people invest in mutual funds for two reasons. They don't have time to understand the market, and they trust that someone smarter is doing it for them. They completely delegate. They think, "I don't understand finance. I'm not an expert. I'll just let someone with degrees and experience do it for me." The irony is that these so-called experts often underperform the market. They're handsomely paid, hold advanced degrees, and sit in offices full of screens. But their investment results over time are often not better, but worse, than simply investing in a basic index fund. I'm not asking you to just take my word for it. You can verify it right now. Ask your fund management company, over the past 10 years, what has been the actual performance of this fund after all fees and inflation adjustments? Chances are, you'll be met with a blank stare. They don't want you to ask that because the answer is often quite embarrassing. Most mutual funds can't beat the market. Some might for a year or two. But consistently outperforming over 10 or 20 years is almost non-existent. Meanwhile, you, the investor, are regularly charged fees. management fees, maintenance fees, transaction fees, and many hidden fees you don't even know about. Every year, a portion of your wealth is silently eroded, not by the market, but by the very fee system of the people who are supposedly helping you. I once saw a study comparing the actual performance of individual investors to the overall market. The results stunned me. Over 20 years, individual investors achieved an average return of only about 3–4% per year, while the market averaged about 9–10%. Why such a huge discrepancy? Because most investors have no plan. They buy when the market is hot, they sell when the market is falling, they act based on emotion, and they are manipulated by fund management companies with specialized jargon and marketing campaigns. And that's why I call mutual funds the best money-making tool for other people. Imagine you hire a gardener to plant fruit trees. Every year, he charges you a high fee, promising a bountiful harvest. But after 20 years, you realize the trees aren't bearing fruit, the soil is barren, and the gardener is still getting paid regularly. What would you do? Continue to employ him or learn to plant trees yourself? Wall Street doesn't want you to learn for yourself, because if you understood that you could invest more effectively than they do, their business model would collapse. They need you to believe that investing is something complex, requiring dozens of experts, sophisticated software, and mysterious strategies. While in reality, successful investing doesn't need any of that. It requires a basic understanding of business, discipline, and a simple yet effective strategy. Let's look at the details. Suppose you invest $10,000 in a fund with an average annual return of 8%, but with a 2% annual fee deducted. After 30 years, you'd have approximately $76,000, but without those fees, you'd have nearly $100,000. Where does that $24,000 difference go, and whose pockets does it end up in? You already know the answer. I'm not saying all mutual funds are bad. A small minority genuinely do well. But how do you know which fund will continue to win over the next 10 years? No one knows for sure. Even the fund managers themselves wouldn't bet on it. Fund management companies are excellent at donning a cloak of ethics and professionalism. They host seminars, publish newsletters, create investment tutorial videos. All of it is designed to make you feel like you need them, that you can't invest on your own without their guidance. They teach you about diversification, about not putting all your eggs in one basket, but they don't clearly state that blind diversification. The kind where you buy hundreds of stocks just for safety is one of the biggest reasons your returns are lower than expected. Think very carefully. If you invest in a fund that holds 300 stocks, where only about 20 of them are genuinely good and the rest are mediocre or terrible, what happens? The profits from those 20 good stocks are diluted by hundreds of other weak ones. The result is that you get an average, lackluster growth rate. Meanwhile, the wealthy don't invest that way. They focus on a few excellent businesses. They understand those businesses inside and out, and they hold onto them for a long time, as long as the value remains. Warren Buffett once said, "Diversification is protection against ignorance. It makes very little sense for those who know what they're doing." What he meant was, if you found a great business at a good price, why would you scatter your attention and money into inferior things out of fear, out of uncertainty? That's not investing. That's amateurish playing it safe. I know many people feel secure investing in funds because they have the sense that experts are looking after their money. But look back at 2008 and 2009 when the market collapsed. How many experts protected you from losses? How many funds truly made smart decisions? And what percentage of your assets did you lose then? The answer for most people is very few and a lot. I spoke with hundreds of people after the crisis. They all had the same feeling of being burned, abandoned, ambushed. They did everything by the book, just as the experts advised, yet they still lost money. That left them feeling helpless. They doubted their own judgment and fell into a loop of continuing to put money into funds, hoping this time would be different. But you can choose a different path. I'm not saying you have to become a financial expert overnight. I'm merely suggesting you learn to look at businesses as a potential owner, learn to evaluate them, learn to read financial reports, not every single line, but the important parts. Learn to determine true value and buy when the market misprices them. You only need a few truly good businesses in your portfolio, not hundreds. And if you do that, you'll have a significant advantage over the majority of investors who blindly put their money into funds. Most people think investing is about timing the market, but that's not only difficult, it's almost impossible. True investing has nothing to do with guessing market movements. It's about choosing good businesses, valuing them correctly, and buying them when their price is low. All you need is a little understanding, a clear strategy, and patience. No one cares about your money more than you do, and therefore, no one can manage it better than you, provided you're willing to learn. Don't let others convince you that you're not smart enough to do it. I started investing with just $1,000, no financial degree, no network, just a simple philosophy: don't lose money. And from there, I built everything. When I first heard the phrase, risk-free investing, I laughed. No such thing, I thought. Everyone always says investing inherently carries risk, always the possibility of losing everything. If you don't want to risk it, it's best to keep your money in a savings account and sleep soundly. But then I met Ty Wolf, my first and only investment mentor, and he said something that stopped me in my tracks. Investing can be risk-free if you understand the 3 Ms, the 3 Ms. I thought he was joking, but then he explained, slowly and surely, as if handing me the key to a door most people never even see. He said, every investment is truly risk-free only if you have the right asterisk meaning business, run by the right moat asterisk, and the right management asterisk. I sat still. It was the first time I'd heard anyone talk about investing without mentioning charts or technical analysis. To invest like a genius, or at least like someone who isn't foolish, you need to choose the right business at the right time, at a price below its intrinsic value. And to be sure you're choosing correctly, you must understand the 3 Ms: meaning, moat, and management. First is meaning. The business you invest in must be meaningful to you. What does that mean? It means you have to understand how it operates. What is its product? How does it make money? And most importantly, you have to care about it. If you invest in a chip manufacturing company that you never research and understand nothing about the semiconductor industry, that's not investing, it's gambling. I once had a friend named Andrew who was so passionate about sports that he knew every tiny statistic for basketball teams. He invested in Nike, Under Armour, and a few other sports fashion brands. He didn't just invest money, he invested deep understanding. When Under Armour faced a media crisis, Andrew analyzed the causes and bought in when the price dropped. A year later, he doubled his money. That's meaning a true connection between the investor and the business. Meaning also helps you stay grounded when the market falls. If you understand and believe in the business, you won't panic. You'll know that the stock price is just temporary fluctuation, while the real value is still there. It's like knowing your house is in a good neighborhood. You won't worry too much when the real estate market experiences slight turbulence. The second M is moat. It's the protective barrier that shields a business from competitors. If a company has an easily replicable product or an imitable strategy, anyone can jump in and seize market share. But if it has a moat like a strong brand, superior low costs, or an exclusive technological platform, that's a huge advantage. Think of Coca-Cola. You can mix soda, you can bottle it, but you cannot replicate the emotional attachment consumers have to that brand. That's a moat. Or Google. You can build a search engine, but you can't change the habit of billions of people who type Google instead of search. That's a moat. One of the most expensive lessons I ever learned was when I invested in a small tech company. It sounded innovative, but it had no moat whatsoever. Their product was good, but after just 6 months, a larger competitor did the same thing, better, faster, and cheaper, and the company I invested in vanished from the map. I lost money, but I gained an unforgettable lesson. If there's no moat, don't invest. The third and most unpredictable M is management. No one can destroy a business faster than a bad management team. And conversely, a good team can rescue even a struggling model. Good management not only knows how to steer the company in the right direction, but also how to allocate capital intelligently, treat shareholders fairly, and act ethically. I usually start evaluating management with a simple question. Do they tell the truth? Do they keep their promises? Do they own company stock? If they don't hold shares, if they're not sharing the risk with you, that's a red flag. I like CEOs who write annual letters as if they're talking to a friend, no embellishment, no hiding. I want to know what they're thinking, what they plan to do, and if they dare to take responsibility. There's a business I really admire, Costco. not just for its unique membership model or competitive pricing, but because of the management team running the company. Their CEO, Jim Seingle, once told the press, "I don't care what Wall Street thinks, I care what customers think." And true enough, he didn't pursue growth at all costs. He kept prices low for customers, paid employees well, and kept operating costs to a minimum. The result was loyal customers, loyal employees, and happy shareholders. He didn't just run a company, he created a culture. One way to vet management is to read financial reports. I know it sounds dry. But you're not an accountant. Just look at a few key metrics. For example, are retained earnings being effectively reinvested? Are they taking on too much debt? Are they buying back stock when prices are high or low? These small details reveal how management thinks. And do they prioritize shareholders? Remember, investing in a company means entrusting your money to its leadership. If they behave like gamblers, there's no reason for you to stay. If they view the company as a shared legacy to be preserved, then it's a worthwhile place to invest. The 3Ms, meaning moat, management, are not mere theoretical concepts. They are vital filters that help you eliminate 99% of the risky investment opportunities out there. If a business is unclear about its operating model, lacks a competitive advantage, and is run by untrustworthy people, then no matter how cheap the stock, it's not worth buying. Conversely, if all three elements are solid and the stock price is below its intrinsic value, you've found an almost risk-free investment opportunity. Think of it like choosing to buy a farm. You wouldn't buy a plot of land where you don't understand the climate, don't know if there's a water source, and the previous owner wasn't transparent about the harvests. But if it's land you know well, with a river running through it, fertile soil, and a decent previous owner, and it's being sold for less than its value, you wouldn't hesitate. Good investments don't need to be complicated. They just need to have the 3Ms, and when you understand that, you'll no longer be swept up in investment fads or swayed by analysts sitting in air-conditioned rooms predicting the market. You'll invest like an owner, someone willing to buy the entire company if possible, not like a speculator. I've been tempted by juicy opportunities before. A hyped-up tech startup, a penny stock rumored to take off. But then I'd go back to the 3Ms, and every time, they helped me avoid huge mistakes. Another time, I almost invested in an emerging energy company. The product sounded revolutionary, the press lauded it, and the stock price was soaring. But when I checked the MS, I realized I didn't truly understand how the product worked. The technology could be easily replicated, and the management team consisted of people who had jumped from other companies with no notable track record. I walked away. A few months later, that stock went into freefall. Many people lost money. I didn't. When you invest correctly, meaning based on understanding and principles, you no longer need luck. You can sleep soundly at night, you won't panic every time the market jitters. And most importantly, you can build sustainable wealth over time. I want you to imagine a morning in mid-March. You wake up, open your computer, and see the market is down over 600 points. Newspaper headlines flash like red lights in a storm. Recession begins, global sell-off, investors panic. You take a deep breath, your hand trembles, your mouse hovers over the sell button. That's the defining moment. Are you a follower of the crowd, or are you the one stepping forward when the crowd retreats? Payback time begins with fear but ends with freedom. When you're afraid, the market knows. It senses your anxiety like a wolf smells blood. That's when TV pundits start whispering about a correction phase, when amateur investors huddle together, chattering in panic, when your friends text you, "Maybe we should pull our money out, huh?" But that is precisely the moment for you to act. If you're prepared, if you've learned to value, if you know which businesses you're pursuing, then fear no longer holds power over you. It's just an amplified shadow without substance. And in that shadow, you see what others miss: opportunity. Payback time is that rare period when good businesses are sold off like defective goods. Have you ever seen people scramble for TVs on Black Friday? Everyone rushes, shouts, pushes just to buy a TV at 50% off. But when the stock of a great company drops 50%, people flee. Isn't that a paradox? That's human nature. We hate losing more than we love winning. The pain of losing money is twice the joy of making it. And that's precisely the weakness the market exploits. But if you realize that, if you learn to keep a cool head in the storm, you'll stand on the other side of the road, where the truly wealthy are quietly buying in. I vividly remember May 2009. The market bottomed out and all financial channels were gloomy. I sent an email to thousands of my students with just one line: time to back up the truck. That was my way of saying that opportunity was right there and wouldn't last. Many didn't believe it, but those who acted that day, following the strategy I had taught, doubled or tripled their assets in just a few years. Not because they were lucky, but because they weren't afraid. The amazing thing about payback time is that you don't need to be good at predicting tops and bottoms. You don't need precise timing. You just need to know the true value of a business, and when the market undervalues it, you buy. It's that simple. Think of it like an hourglass. Time flows, sand falls. But if you know when the glass is nearly empty, when the market is oversold, when emotions have hit rock bottom, then you'll know it's time to act. No panic, no forecasts, just trust in your calculations. If everyone is scared, how can I be sure I'm right? The answer is you can't be completely sure, but you can have a much higher probability of being right if you rely on data, not emotion. If you buy a business with stable profits, strong cash flow, and transparent management at a price 50% below its true value, then even if your timing is off, you're still fundamentally right. That's the power of the margin of safety. It's like building your house on land higher than sea level. Even if floods come, you still stand firm. The margin of safety in investing isn't some mystical thing. It's the gap between the price you pay and the true value of the business. The wider it is, the safer you are. The narrower it is, the more easily you can be swept away. And payback time is that rare moment when the market willingly grants you the largest margin of safety. Someone asked me, if everyone knows they should buy when the market falls, why do so few people do it? The answer lies in the fundamental nature of human psychology. Fear is a primal emotion deeply programmed into our brains. When we see others run, our first instinct is to follow, without asking why. That's how our ancestors survived predators. But in the financial markets, that very instinct causes us to lose money. To invest successfully during payback time, you don't need to overcome the market. You only need to overcome yourself. Remember, the wealthiest people aren't smarter. They're better at controlling their emotions. There was a woman named Linda. She was an accountant, not a finance professional, but she learned how to analyze businesses, how to value them. And when the market collapsed, she didn't sell off. Instead, she bought shares in a retail chain she understood very well. Within 4 years, her investment multiplied fivefold. She didn't do anything magical. She simply did what the majority lacked the courage to do. Payback time is a moment for action, but not action based on herd mentality, rather, action based on understanding. If you invest based on fear, you'll run when you should stand. You'll sell when you should buy, and you'll regret it when you look back. But if you learn to embrace fear and use it as a reverse compass, you'll see that when people are screaming, you should listen. When people are selling off, you should buy. When people give up, you should prepare to get rich. I once spoke to a group of finance students. I asked, how many of you have ever ridden a roller coaster? Almost everyone raised their hand. I then asked, who has ever regretted it midway and wanted to stop? A few hands retracted, some awkward smiles appeared. I said, the financial market is the same. When it goes up, everyone is excited. When it falls, they panic. But those who know that this ride is just a cycle will calmly enjoy it. And payback time is the biggest drop. But it's also when you can buy a first-class ticket at a deeply discounted price. The market is a machine that transfers money from the impatient to the patient, from those who react emotionally to those who act on principles, from the panicked to the informed. Wealth doesn't come overnight. It comes through small, deliberate, persistent, and precise steps. You don't need to win the lottery, you don't need to become a CEO, nor do you need to invent a new app. You just need to follow 8 steps. 8 small steps, but with the power to transform your entire financial future. I call them baby steps. They might sound simple, even naive, but don't let the name deceive you. Each step is designed to bring you closer to financial freedom, not by luck, but by conscious choice. The first step, determine the rate of return you need to achieve your financial goals, not the rate others tell you to expect, but the actual number you need. If you're 30, have $10,000 saved, and want $1 million by retirement, what percentage annual return do you need? The answer isn't difficult, but you have to sit down, open your computer, and calculate it yourself. Once you know the number you need, you'll no longer be distracted by the flashy invitations from experts or investment funds. The second step, Clearly understand the difference between averaging and volatility. Many people invest based on average returns. For example, they think that if the market averages 10% growth per year, their account will grow similarly. Completely wrong. If you lose 50% this year and gain 50% next year, you're not back to square one, you're still at a loss. Understanding the nature of risk means understanding that volatility can kill average returns. That's why you need to invest in businesses with real value, not just because you hope the market will recover on its own. The third step, understand and leverage the principle of market inefficiency. This might sound contrary to the doctrines you learned in economics school, but the truth is, the market isn't always right. Humans are emotional beings, and the market is a collection of millions of humans. This means it cannot always be rational. Sometimes it's overly optimistic, sometimes overly fearful. Your job isn't to predict that collective emotion, but to exploit it. When the market undervalues a good business, that's when you act. The fourth step, learn to recognize when fear dominates. Payback time isn't a specific time of year or a phase in a cycle. It's the moment when collective emotion hits rock bottom, when financial news headlines are all gloom and doom, when your best friend decides to sell off all their stocks, when the media says it's the financial apocalypse. That's precisely when you need to be more alert than ever. It's not the time to run, it's the time to start buying. The fifth step, choose the right businesses to invest in. Based on the 3 Ms, this isn't the first time you've heard me mention meaning, moat, and management, but in this step, you'll apply them practically. Create a list of businesses you understand, check their long-term competitive advantages, and evaluate the quality of their management. The great thing is you don't need 100 businesses. Just a few truly good names, bought at the right time, are enough to build sustainable wealth. The sixth step, learn how to value a business. This is where things get interesting. You don't need to become a financial expert, but you do need to know how to estimate the true value of a business based on future cash flow and reasonable growth. I'll guide you through a simple yet effective formula to do this in the upcoming chapters. Once you know the true value, you'll know when a stock is on sale. The seventh step, establish a stocking system. Accumulate shares strategically. This is where most amateur investors miss out. They buy stocks hoping they'll go up, then passively wait. But you're not waiting for luck. You are actively accumulating shares of good businesses when their market price is below the true value you've identified. Each time the price drops further, you buy more, not because you're foolish, but because you clearly understand that the business deserves to be owned at a cheaper price. You're not speculating, you're building an ownership position like a quiet founder steadily accumulating shares. I call it stocking slowly, disciplinedly accumulating at the right time. It's like you're hoarding gold while others think it's just scrap metal. And finally, the eighth step, determine your exit point. The point at which you will sell shares if the business no longer meets the 3 Ms investing isn't rigid. Sometimes you need to leave, not because the stock price fell, but because the nature of the business changed. You need to monitor periodically. If the management team becomes less transparent, if the competitive advantage disappears, or if you no longer clearly understand the business, it's time to say goodbye. Many people cling to stocks like an old dream. They refuse to sell because they once loved the company. But investing isn't about emotion, it's about discipline. You buy when the conditions are right, you sell when the conditions are no longer met, no panic, no regret, just acting at the right time. 8 steps sound simple. And yes, they don't require a finance degree, no network of experts, just you with a clear head, a precise strategy, and the courage to go against the crowd. Imagine you're standing amidst a sea of people fleeing a building due to a fire rumor. Instead of running with them, you stop, verify the source, and realize it's a false alarm. While others rush out, you calmly walk back in and buy the items they abandoned at a cheap price. That's the essence of investing when the market is scared. That's payback time. These steps aren't just instructions. They are a compass guiding you through financial storms, a map you carry throughout your investment journey. And if you follow it step by step, you'll reach your destination not by luck, but by understanding. We live in the age of data, mountains of numbers, charts, ratios, indices, all flooding you every time you open a financial news report. And then people tell you to do your homework. But no one explains what that homework is or how not to drown in the chaotic mess of data. I was like that when I first started learning to invest. I was obsessed with terms like PE, PB, ROE, ROA, EPS, and so on. I tried to understand it all, check it all, and then, like most people, I got confused. But then Ty Wolf, my first mentor, pointed to an Excel spreadsheet and said, "Forget all that, just use FAST." FAST isn't a magical tool, it's a filter. It's what keeps me from being distracted by market noise. And you need it too if you want to invest like a business owner, not a financial gambler. So what is FAST? It stands for 4 numbers: free cash flow, return on invested capital, equity growth rate, and sales growth rate. These 4 numbers, if you understand and know how to use them, will bring you closer to the heart of any business. First is free cash flow. Imagine you own a bakery. Every month, you subtract all expenses, flour costs, employee wages, rent, and the money left after all that is your free cash flow. It's real cash. Cash that can be used to open more stores, pay dividends, or save for difficult times. If a company doesn't generate stable free cash flow, or worse, is consistently negative, then I don't care how groundbreaking its product is. No cash flow, no investment. The second number is return on invested capital, ROIC. It tells you how much profit a company earns from every dollar of capital it invests in its business. You want to invest in a company where every dollar put in generates many dollars of profit, like a farmer planting one seed and harvesting a whole basket of fruit. If ROIC is low, it means the company isn't optimizing its resources, and you're putting your money into a leaky machine. Third is equity growth rate. This is a long-term indicator showing that the company is genuinely growing over time. If you see equity steadily increasing for 5 to 10 years, that's a sign that the company is developing sustainably, not through debt or accounting tricks, but through real capability. And finally, sales growth rate. You can have good cash flow and high ROIC, but if revenue isn't growing, the business will hit a ceiling. Consistent sales growth is a sign of stable market demand and products with real value. I don't look for companies that grow like rockets because they're prone to burning out. I look for companies that grow like oak trees, slow but steady. These are the 4 numbers, 4 vital signs. If all 4 are strong, you're looking at an ideal candidate for investment. If only 2 or 3 numbers are good, you need to dig deeper. If only 1 or none are stable, you know you should pass. You might ask, where do I get those numbers? It's easy. The company's website, annual reports, financial platforms like Morningstar, GuruFocus, or Yahoo Finance all have them. But don't just look at 1 year, examine at least 5 to 10 years. The trend is what matters, not a snapshot. A company might have good cash flow in 1 year by selling assets or cutting staff. But if you see cash flow consistently increasing over a decade, that's reliable. FAST isn't a tool for market timing or predicting growth. It's a compass. It points you in the right direction. It doesn't tell you when you'll reach your destination, but it helps you avoid getting lost. A guy named Chris, a software engineer with no financial background, told me, "I read investment books, but the more I read, the more confused I get." I gave him a FAST spreadsheet. Within 2 weeks, Chris had evaluated 7 companies on his own, eliminating 5 due to unstable cash flow, and chose to invest in 2 extremely solid names. 6 months later, Chris's portfolio grew by 25%, not through luck but thanks to FAST. But don't misunderstand, FAST won't help you pick stocks that triple in a single quarter. That's a speculator's dream. Investors don't need that. Investors want to see their money placed in businesses with solid structures that create real value over time. FAST doesn't replace the 3 Ms, it merely provides you with additional quantitative evidence that the meaning, moat, and management you assess through intuition and qualitative research are indeed reflected in the numbers. If a company has good management, a clear competitive advantage, an easy-to-understand model, and all 4 FAST metrics are strong, you're looking at a stock worth owning. You don't need to pick all the winners. You just need to eliminate the weak companies. As Warren Buffett once said, you don't have to swing at every pitch. You can wait for the fat pitch. Investing isn't the privilege of an elite few. It's a skill for those willing to learn and be patient. And it all starts with just 4 numbers. We've talked too much about numbers, formulas, markets, strategies. But investing at its core isn't just about money, it's about life. It's about peaceful dinners without worry, deep sleep knowing your children will have a solid foundation. And nowhere does this become clearer than in the story I'm about to tell, the story of the Joy family. When I first met Jim and Kathy Joy, they were in their 50s, living in a small town in Michigan with 2 daughters, preparing for a rather unremarkable retirement. They weren't rich, weren't poor, just the kind of people you'd meet at any local supermarket. Simple, quiet, hardworking, believing in old-fashioned values. Jim was an engineer, Kathy an elementary school teacher. They had saved their whole lives, putting money into mutual funds recommended by their bank, hoping everything would be okay. But then the market crashed in 2000, the dot-com bubble exploded, and their retirement account lost nearly 40%. We just sat there watching the numbers drop every week, Jim recounted, and there was nothing we could do. I met them at a small local seminar I hosted. They sat in the 3rd row, taking careful notes, not asking a single question throughout. Only at the end did they come to greet me. Kathy said, "We don't know anything about investing, Phil, but we don't want to be fooled again." I sent them the first PDF of the Rulon method, the one I had originally written for myself. I told them to read it and then call me. 3 weeks later, Jim called. His voice was gentle yet resolute. "We want to try." And their journey began from there. We started simply. We identified the rate of return they needed to achieve financial freedom in the next 10 years. That number was 15% annually. Not easy, but not impossible. Next, I taught them how to find good businesses, meaning Moat management. Initially, everything was new, but they were patient. Jim said, "I went to engineering school, I can learn this." And Kathy added, "It's like teaching 3rd graders math. If you break it down enough, anyone can understand." They made a list of 10 companies they knew and trusted. Not unfamiliar names, but brands present in everyday life: Costco, Johnson & Johnson, and Procter & Gamble. Names you might find in any family's refrigerator or bathroom. They analyzed, took notes, read financial reports, then learned how to value. They weren't in a hurry. For the first 6 months, they didn't buy any stocks. They just learned, observed, and waited. Then came May 2003. The market was still gloomy, the Iraq War was escalating, and fear flooded the news reports. But the cash flow of a few businesses they were tracking was increasing, and their stock prices were 50% below the true value they had calculated. And for the first time, they pressed the buy button. Initially, they bought small amounts, a little Costco, a little Johnson & Johnson. Then they saw something amazing happen. It wasn't that the stock prices immediately shot up, but rather a sense of ownership. For the first time, they were no longer passengers on the market's shaky ride, they were the drivers. Every morning, instead of worrying about financial news, they checked quarterly reports, read shareholder letters, updated their data. They understood what they owned. And when the market dropped further, they didn't panic. They bought more in small increments, accumulating. It was like building a house brick by brick. By 2007, they had accumulated a portfolio of 7 companies. All of them had meaning, moat, and management, with solid cash flow and growth. They didn't diversify blindly. They invested selectively, and most importantly, they didn't act out of fear. Then 2008 arrived, and the market crashed again. This time, they did something many found unthinkable. They doubled down on their investments. Jim told me, "We knew the companies we owned hadn't changed. It was just the stock prices that were temporarily insane." While millions fled, they backed up the truck, loading it with more. Each time prices dropped, they strategically, logically, and faithfully accumulated more. And then, in 2012, I received a handwritten letter from them. I still keep that letter today. The neat, small handwriting read, "Dear Phil, we just sold a portion of our portfolio to buy our dream lakeside home. We're retiring next year. Jim will go fishing every morning, and I'll teach for free at the village school. Thank you for teaching us how to no longer be afraid." I read the letter and was silent. This is what investing can achieve, not just for those with MBAs, not just for Wall Street insiders, but for anyone willing to learn, understand, and brave enough to go against the crowd. Jim and Kathy didn't get rich by winning the lottery. They didn't hit a jackpot. They didn't deify me. They simply followed the principles, understood businesses, bought below value, accumulated gradually amidst fear, and waited. I'm not telling this story to inspire you. I'm telling it because it's real, and because you, no matter who you are, can do the same. Who wouldn't want free money? Sounds like a scam, doesn't it? I understand, because in the investment world, the phrase free money often comes with fine print below: extreme risk, insane leverage, or a legitimate trick within Wall Street's shady boundaries. But what I'm about to tell you isn't financial magic, nor a secret strategy requiring special certifications. It's a simple, legal, and safe approach if you know what you're doing, and I call it BKY. BKY is the informal name I've given to a financial tool that the wealthy quietly use, while most others haven't even heard of it, or if they have, they don't understand its power. And most financial advisors will never mention it to you. Why? Because if you know how to use BKY, you won't need them anymore. BKY is an informal term for selling put options on high-quality companies you are ready to own at a discounted price. It means selling put options on high-quality businesses that you are already willing to buy, but want to buy at a price lower than the current market. It sounds technical, but don't worry. I'll explain it as if you've never traded options before. Imagine you want to buy a fantastic business like Costco, but you think the current price is a bit high. You're willing to buy it at 10% or 15% lower. Instead of passively waiting for the price to drop, you do this. You commit to buying that stock if it falls to your desired price within a certain period, and in return, you get paid immediately. That's the essence of selling a put option. You become the guarantor for someone else's right to sell you the stock to you at a predetermined price. If the market price drops to that level, you are obligated to buy. If the price doesn't drop, you don't have to buy, but you still keep all the money they paid you. Real money, no loans, no risk, as long as you're genuinely willing to own that stock. So why is this strategy kept quiet? Because it's so simple that people think it can't be effective, and also because Wall Street doesn't make money when you do this yourself. They only make money when you're scared, when you need them, or when you believe investing is too complicated to handle on your own. I've used the BKY strategy for years to buy businesses I love at better prices and still get paid just for waiting. Let me tell you a specific example. In 2009, I wanted to buy shares of a large, sustainable railroad company with a clear competitive advantage. The price at the time was about $65 per share. I valued this business at $70, so I wanted to buy it if the price dropped to $60, providing a margin of safety. Instead of passively waiting, I sold a put option with a strike price of $60, a 30-day expiration, and I received $3 per share in cash immediately. Two possibilities arose. If the stock price didn't fall to $60 within 30 days, the option expired worthless. I didn't buy the stock, but I kept the $3 in cash. If the stock fell to $60 or lower, I was obligated to buy it at that price, meaning I bought it at exactly the price I wanted. And since I had already received $3, the actual price I paid was only $57. I want you to visualize this. You're being paid just for agreeing to buy a great business at a price you already wanted to buy it at from the start. You're not gambling, you're not speculating, you're simply receiving compensation for your patience. And you can do this repeatedly every month with every company you've thoroughly evaluated, understood its 3 Ms, meaning Moat, management, and are waiting for an opportunity to buy. The more patient you are, the more you get paid, and sometimes you never even have to buy the stock but still earn regular profits just for being willing to own them. This sounds too perfect. Where's the risk? The only risk is that you're forced to buy the stock at the price you agreed to during a market panic, and as you already know, that's precisely when you should be buying. As long as you don't indiscriminately sell put options on companies you don't understand or at prices you're unwilling to pay, you are completely in control of the game. I'm not saying this strategy is for everyone all the time. You need to understand it thoroughly. You need discipline, and you need to have cash readily available in case you are required to buy the shares. But for those who are prepared, it's a powerful tool. I've seen my students use this strategy to boost their retirement income, to reinvest in quality stock portfolios, to build accounts from a few $1,000s to hundreds of thousands of dollars. Not by beating the market, but by leveraging the impatience of others. You're an insurance seller, but instead of insuring against accidents or illness, you're insuring fearful investors against a stock falling. You tell them, if the stock drops to this level, I'll buy it from you. In return, they pay you money, and you are perfectly willing to hold that stock long-term. That's the spirit of BKY. This isn't a Wall Street secret, but it's something Wall Street doesn't want you to know. Because if you can invest with discipline, understand business value, and use an options strategy intelligently, you don't need anyone. You don't need funds, you don't need brokers, you don't need premium investment packages. You just need yourself. And that, true financial freedom, is what I call free money. A new generation of investors is emerging, people who no longer accept ambiguity. no longer believe in blind diversification, and are willing to go against the current with reason, not emotion. Because you don't need to do extraordinary things to achieve extraordinary results. You just need to do things simply, consistently, with reason and conviction. I believe a silent revolution is underway, not loud or chaotic, but profound and irreversible. It's not in protests, not on the front page of financial newspapers. It starts in humble kitchens, from personal computers, from ordinary people. People who say, enough is enough. I want to understand. I want to control my own money. I call it the rule-on revolution. What is rule-on? It's not a specific investment strategy, not a magic formula. It's a living principle: don't lose money. And from that principle, every investment action becomes clearer, more logical, and more humane. You don't have to take big risks to get good returns. You just need to avoid foolish mistakes, the gambling disguised as extreme diversification, trend following, or blindly trusting experts. Rule On teaches you not to become a genius, but to become disciplined. And what excites me most is that I see more and more people, from students to single mothers, from laborers to veterans, teaching themselves how to invest, not to get rich quickly, but to reclaim their freedom. They are reading financial reports, they are analyzing businesses. They are applying what I and many others have shared with remarkable seriousness. The rule on revolution doesn't need leaders, it needs *U**. The reader of this book to step out of the vicious cycle of fear and begin to believe in your own ability to take control. It needs you to put down the remote control, turn off the financial news, and open your computer. Find out what a company actually produces, who it sells to, how much money it makes. It doesn't need you to be good at math, it needs you to be patient. I met a 19-year-old boy, a college student with no money, no investment account, but he had read all my books. He emailed me, "I have nothing yet, but I know how I will get rich, I just need time." And I believe him because he already possessed the most important thing, a correct mindset. What I admire about those who follow Rule On isn't how much money they make, but how they change the way they see the world. They no longer fear every market downturn. They aren't dragged along by the crowd. They don't buy or sell out of panic. They invest as if buying a farm, understanding the soil, the crops, the seasons, and they are willing to wait for the harvest. I once heard someone say that if investing is a sport, Wall Street is the team trying to hide the rules. Rule On doesn't give you weapons to defeat them, but it gives you a club to play your own game. With Rule On, you don't need to be smarter than anyone else. You just need to be different in 3 ways. You clearly understand what you're buying, you know its true value, and you patiently wait for the market to make a mistake. It's simple, but not easy, because the crowd always makes you feel like you're out of place, and so you need courage. Remember, Wall Street has a multi-billion-dollar industry designed to confuse you. It thrives on commissions, on complex products, on sugar-coated advice. Rule On doesn't. It thrives on transparency, simplicity, and your ability to do it yourself. And you can start right now. No large account needed, no professional license, no one's permission. Just be willing to read, learn, think, and act. You won't win every time. You might pick 1 or 2 wrong companies. You might see a stock fall right after you bought it. You will have times you doubt yourself. But if you stick to your principles, don't buy until you understand, don't buy without a margin of safety, don't sell out of emotion, then you will survive. And not just survive, you will win. Look back at what you've learned in this book. You understand why mutual funds aren't the solution. You've grasped the 3 Ms, meaning Moat management. You've learned how to read the 4 fast metrics to know if a business is healthy. You know how to stock shares like a true investor. You've been shown how to receive free money through a rational options strategy, and you've seen an ordinary family, the Joys, achieve what everyone thought was only for the rich. Now it's your turn. I don't know who you are. Perhaps you're a student, a single father, an office worker worried about retirement, a woman who had half her assets lost by an expert, or simply someone tired of feeling no control over their own money. I don't know who you are, but I know one thing: you can do it. And no, it's not about getting rich overnight, not about becoming the world's next investment genius. It's about becoming the only person responsible for your finances. It's about being able to sit in front of a blood-red market screen and smile, "This is my payback time." If you remember anything from this book, remember this: freedom doesn't come from having a lot of money. It comes from no longer being afraid of losing it. Start with 1 business, 1 report, 1 calculation, 1 decision, then 1 step, then 1 action. And then you'll no longer have to ask anyone else, "What should I do with my money?" You'll know the answer. Because you are your own investor. How long has it been since you truly played? I mean truly played, not a quick break between meetings, not a vacation where you still check work emails, but the kind of play that's unrestrained, purposeless, unbound by anything but the joy of the moment itself. I ask this not to philosophize, but because I know one thing: most of us have forgotten how to play. We grow up, then tie ourselves to responsibilities, duties, bills, retirement plans, and call it maturity. But deep in your heart, there's still a part of you that longs to be at ease, to be creative, to live as if there's nothing left to prove, as if you are already whole. And do you know what holds you back the most? Fear. Fear of not having enough money, not being safe enough, not being secure enough. And so you keep working, keep running, keep yourself on that hamster wheel, even though your heart has longed to step off it for a long, long time. I wrote this book not just to tell you how to make money, but to show you how to reclaim your right to play. To play in the deepest sense, to live a life you genuinely choose. If you've made it to the end of this book and are still here with me, then I know one thing for certain: you are someone who wants more than mere existence. You want freedom, and I believe you are getting closer to it. Not through financial tricks, but through a transformation in how you perceive your financial responsibilities. No longer a burden, but a leverage. No longer a chain of worries, but an opportunity to create a different kind of life. Many years ago, I stood on a hill in Peru. Below me was a small, poor village without electricity, without internet, but filled with laughter. Children ran barefoot, adults sat together sipping herbal tea. I realized they had very little, yet they lived more fully than most people I'd met on Wall Street. That was the moment I began to understand. Money isn't the destination. It's a tool, a means, something that helps you unlock choices. And then, if you're brave enough, the choice to play, the choice to live. I don't know what you'll do when you achieve financial freedom. Maybe you'll travel the world. Maybe you'll write a book, open a small cafe, teach for free, return to care for an aging parent, or simply sleep without an alarm clock. Whatever it is, I only hope you remember this: you don't need to wait until you're old and gray to live the way you want. Over the years, I've met people who did something seemingly simple. They learned to invest, they regained control of their money, and then they chose to play. None of them waited until they had $10 million in the bank. They just waited until they knew they could live without being dependent. They didn't buy more assets, they bought back their own time. There was a man named Alan, a mechanic in Oregon, who once told me something that left me silent for days. I learned to invest to buy back my freedom, not to buy more asterisk things. That was the epiphany of a man who once worked twice the hours the clock allowed just to survive. And now, he wakes up early not to go to work, but to walk in the forest. He fixes cars when he wants to, and he no longer fears the bills at the end of the month. Or a single mother named Ja, who once worked 3 jobs at a time to support her 2 children. When she learned how to invest $500 a month, she didn't imagine getting rich. She just hoped that one day she could come home early and cook dinner with her children. 7 years later, she did exactly that. And when I asked her if she felt successful, she just smiled, said nothing, and pulled a picture from her purse. It showed her and her 2 children eating dinner, the candlelight casting a warm glow on their faces. That, she said, is success. You see, the sweetest revenge isn't how much money you make, but how much of your life you truly get to choose to live. You are no longer a victim of the system, of the market, of an endless chain of bills. You don't have to beat anyone. You just have to beat yourself, beat procrastination, beat laziness, beat fear. And then you play. You play like someone who has learned how to make money, how to protect it, and who is now no longer controlled by it. Before you go out and play, just do one thing: start. Start with one financial report, one stock, 1 hour of learning each week, one small step to break away from the rut. Then little by little, you'll see you don't need magic. You just need a clear plan and a persistent commitment. You hold in your hands not just knowledge, but the key. Use it and then go play. Thank you for patiently accompanying the Payback Time book. A journey that doesn't promise roses but dares to dissect the truth. You haven't just heard about how to invest. You've delved with me into the layered sediments of human psychology, pervasive financial illusions, and the very human hopes for freedom, for choice, for the right to be at ease. If anything remains after all the numbers, the fast metrics, the BKY strategies, it's this: investing begins not with money, but with attitude. It begins by pausing and asking, am I living authentically? What am I working for? Have I ever truly chosen, or am I just reacting? I hope this book, if it doesn't change how you invest, at least makes you pause, reflect, and start seeing finance as a way to reclaim your time, not trade it away. If you found anything valuable in this book, even just a line, an image, or a question that unsettled you, I encourage you to share your thoughts. Not because I need praise, but because I believe that what is pondered and spoken becomes more vibrant within a community. Leave a review, a comment, or just a heartfelt statement. What will you carry with you after closing this book? And if you hold another book, a work that puzzles you, tears at you, or simply sparks your curiosity, tell me about it. I'm not looking for easily digestible reads. I want to dig with you into the hard-to-chew things, the things no one has had time to listen to long enough. You suggest, I listen, and if possible, I tell the story. Finally, remember, don't let this book merely live in your read list. Let it impact your daily decisions when you look at your account screen, when you stand between confusion and conviction, when you hesitate between playing on or stopping. It is in those very moments that knowledge will transform into intuition, and you will begin not just to invest, but to live as someone who has truly chosen.